So again, materials, consider the fact that directed materials are the major materials used by contractors. Here is one great advice. Obtain at least 3 quotes. Now, sometimes you may not, if you get 3, but you want to have some friendly competition. You want to push them to make sure that you are getting, a reasonable cost. Sometimes you may not go with the lowest cost. Like some companies do that and it kills me because you should be going for what the best supply is or what the best quality, right? Look at that quality, not just cost, right? So, but a lot of these companies, they look at cost and that's it. And cost wins out because then they are mad at the end when they didn't get the quality. Right? Negotiate terms with major material suppliers to help improve cash flows. And that's what you got to be thinking about. How do I improve cash flow? So if it's because I want to seek another bid from a supplier who's going to supply data, then I'm going to do that. If that's me, their contract, whatever, I want, see, but contractors charging me more now. I may have to go look for somebody else, even though they've been consistent in my business because they messed up my margin. Right? I got big bills too. So real quick, you guys know this break-even analysis, right? It really comes here. Is the cost, right? So price per unit times quantity, which is variable cost per unit times quantity plus fixed cost. So I do the other one. You have your fixed cost, right? By the time your overhead, right? Yeah, build fixed cost, that overhead. And you're going to say, okay, if I have, what is the quantity times the variable, if I figured out that my variable cost was $20, then all I do is multiply by the quantity. Is that 100? Then it's 200, right? So that's the key to getting to the break even. And then that's when you know what revenue you have to generate to at least break even. You got to do that calculation.
You have to do in loans here?
Say it again?
They allow you to do in loans?
Well, that's so great question. So she's asking, we're not including loans. Really, you're not including interest. What you're doing is that's technically part of your fixed cost, because you know what that's going to be. That's really right here. Where the key is to understand the variable cost and know if I have to have 20 units, what's the cost per unit that's going to get me to break even? And then I know where my revenue is going to be. And then I know how I'm going to price it. This is really pricing a job. So I know how to price this job. Because you should not enter a contract on a job where you're losing money. Unless for some reason you really truly believe this is going to get you other jobs and get you quals to get bigger paying jobs. We kind of talk about indirect costs next. Estimated cost to complete, again, I think we try to talk about that. You got to estimate your cost from beginning to end of completing a job. And that's going to tell you what your revenue is going to be, how do you book your revenue. So your bookkeeper should know and should be very accurate as to all costs. Now, a lot of times what happens is you guys are working so hard and moving around a lot and doing things on credit cards and what have you, that your bookkeeper doesn't have this information until too late. So you got to make sure you have a system in place to make sure that your bookkeeper, so you went out and spent your own money on stuff that you have to be reimbursed. And say it's like $15,000 you paid out of your own pocket. You should be paying out of the business, but a lot of small businesses pay out of their pocket. And then all of a sudden, 3 months later, they're like, oh man, I forgot to give you all these, receipts. Like, cause they knew that, they're going to pay their credit card down. Their personal credit card down. Well, that could have really screwed up your financial results. And then you got to go to the bank with the quarterlies. Right? And that's another $15,000 that this came out of the blue. You got to get that. You got to have a system to give it to your bookkeeper immediately. Question. Oh, I'm sorry.
My question, I know others were asking about how you get comfortable, and you brought up the suggestion about getting money when you don't need it. So
right.
So like getting lines of credits as opposed to an actual form of loan is a good way to do that. Exactly, because you don't have to be paying out if you're not using the money, but then it gives you some sort of cushion. And then to your point about the bookkeeper and CPA, I'm sure, everyone at this point, our bookkeeper checks in monthly, give them the statements, and then, if we do quarterly or semi-annual meetings with our CPA, kind of see.
So, and that last point is so important, right? Or every point you made is important, but that last one is, a lot of times I see small business not meeting on a regular basis with their bookkeeper, at least quarterly, just to go, where are we at? What's happening? Or what are you missing?
Right. Because they're paying for it at the end of the year anyway, and you try to clean up the books from the year. So you might as well just stay on top of it monthly. That's kind of racy.
But you may pay for it also when you're going to bid on a job and they're asking for that financial information as well. So that's the other thing too. Like you got to make sure that it's always up to date so that boom, when they ask for it, you're like, oh, there it is. Yeah. But, right. Yeah. Yes.
You were saying that there's a system that you should have that without bookkeeping.
Yes.
Can you give us some kind of idea, the clues on what is?
That's going to cost you $1,000. No. Sure, we'll come up with some sort of template for you. Look, he works for an accounting company, and he worked very closely with the small business construction company for many, many years. Shameless plug. This is a guy you want to have not in case of emergency, but to have him as a resource. If you could, you need.
Yeah, I mean, it's so important. I mean, there's so many systems, like even, some upscale ones are Concur, right? You put their expenses in and manually providing they use American Express, it automatically goes into the system so that, the bookkeeper can go look at it and say, all right, this is how I'm going to report it. But sometimes they need to find out from you what it is. Like you go to a restaurant, they have no idea what you did, how you did it, who you were with, what job it was for, blah, blah, blah. So they need that detail from. So that's what I mean about a system. So sometimes some people just say, you know what, I'll just scan it, I'll write on it, scan it through my phone, and boom, it goes right to them. Much easier for you. So that you can even throw it away the receipt because it's already scanned the same night that you did dinner or order supply. So again, paper flow, we go to the next one. I think we just talked about that next, cash flow. So we talk about that. Cash is king, right? Your lenders, other investors also. We ain't talking about that, right? If, someone wants to invest in your business as well, right? You gotta have financials. I know I'm gonna invest in someone's business. Ain't no way I'm going to just say, all right, in my money, go do it. It looks like you're doing a great job. I'm gonna peel that onion. I can't get $1 from me without peel that onion. So, and there's important for investors. And there are two ways. You may want to, employee's been faithful and great, and you want to keep that person in. You may want to give them some equity in your business as well. So this is a real chance to do so. And that really encourages them and empowers them to even do better in your business. So that's always like a lot of small business owners don't think about that.
Yeah.
And they'll have people work 30, 40 years for them and never thought about giving them some stake in the business and really empowering them to do better. That's how you pick the business to the next level.
That's right. And to that point, ESOPs. Do you guys do ESOP?
Yeah, of course.
Yeah. So employee stock options, that's a very great way to create some kind of long-term relationship with your employees.
Yeah, employee stock option plan.
I don't know how exclusive it is set up, but
Well, most of us here are small business, right? And one thing that I feel as though sometimes we're struggling ourselves to make the numbers work.
yeah.
And giving somebody a stock option is going to put more power and more strain on you. So you give little, like a couple $100 bonus, $1,000 bonus. Yeah. You're buying a house, do something like,
Yeah. So that's a good point because bonuses are great. But in terms of, we're talking about retention, long term. I have people who work with me for like 10 years, 15, 20 years. This guy right here, he's going to go out of the hell and selfie. So I think no different from, it's really about building loyalty, right? Because when you have talent that's so good, what makes them stay with you for 10, 15 years, right? So there are companies that in America, they built such a family style environment where the guy says, look, you know what? every milestone in my family, I'm gonna do this, and that's how you build a relationship. But Theo, this is a great point you made that it's something that has to be done incrementally, right? And because hedge against the risks of the market and all.
If you're a smaller contractor, you have a house, you got to pay a mortgage, right? Let's say you pay yourself $100,000 a year, and you have your employees make you paying him $8,000 a year, let's say. Now, with the stock option, they give you shares out, and this person doesn't give you up a partner now. I want to sell. You got to fight to struggle to pay for that to some of it's tough. Yeah. It's a fine line. Do small incremental, hope with your
option always also encourage try. You just blow you as well. So what did it be, personally to how you fit your business? Yeah. So it's not always pointed to courage draw.
Yeah.
Yeah, performance metrics, good performance metrics.
It's so important. But now they add this. So once they become a owner, now also they look at the side that you look at that, right? And that's about cost attainment, right? Now also they want to attain cost. Before they're like, we gotta spend more money. I'm working too hard. Now they know that they get $1 maybe for distribution because earn some money. They're like, oh yeah, you're right. We can't spend extra money on that. Because they're looking at to go in their pocket. That's another reason why, you gradually, bring them into business as an owner. But it's a pride beat for them as well. So one of the things I talked about earlier about ratio, and this is what you want your accountant to do, right? You want them first to say, what is my current assets over what is my current liabilities? Because that's the ability to cover up immediate short-term debt, right? That amount. That's also, your working capital, all right? Where you can embed it back into the business. That goes back to the operations of the business to pay for the operations. So you want to look at the current ratio, the current assets over current liability. That's called current ratio, right? It should always be more than one. Obviously, if it's less than one, then you got a problem. Right? Because that means you're borrowing just to say a lot. Right? So typically you want to aim for the 1.5 to 1. So current assets should be 1.5 to 1 liability or more. Very important. And you want to look at it, to me, on every quarter to see where you are. But there may be some dips. And that's when I need to go out and borrow. So at least you anticipate it way before it's too late. And what you may do is go to a bank when it's high, right? Just to say, you know what? I may have to borrow from you. With you, right? I may have to borrow from you, down the road, 6 months down the road. So I'll create this facility that I can just pull down. And this period that I know that ratio is going to go down a little bit because that's where it gets tight in my business. And you sitting down with the accountants, give me this data, you looking at it and saying, and making suggestions and what have you, and making sure you may have to peel an onion and make sure they account for right. And then, quick ratio is, and this is when you're doing well, right? Where you have cash, you're able to even invest it a little bit, and you kept it in the business, you invested in multiple securities, you have your AR. Again, we're talking about the AR. It's so important to collect on that AR quickly. But the ARs always can be converted to cash. So you have this quick ratio where you have that over current liabilities. Usually that is, your cash or your receivables is 0.75 to 1. You want it to be 1-to-1 at least. Because again, that means that you could just easily take cash to pin down your liability like that. Right? So inventory is considered more long term, but put the inventory in there or even prepaid assets, don't put in there. But your accountant should be going over these ratios with you so you can see trends. If you're trending, if each year you go from 1, that current ratio goes from 1.2, then the next year 1.5, then the next year 2, you're doing something. You're doing something right. If it's going down, you're like, hold it, let's stop. Something's wrong. I don't know what I'm doing wrong, but we're doing something wrong. So again, I think we talk about most of this, right? The operating cycle is the period from the time that the company purchases inventory to the time or pays salaries. to the time it receives cash from its customers. That's when cash is king. This part right here, accounts payable serves as a source of working capital. So what I mentioned was that big companies push you, right, on paying their debt to you, right? They owe you $100,000. They're like, we'll pay it in 90 days. Well, guess what? You could do the same thing. Now, it may mess up your relationship though, so you got to be very conscious of that. But to your suppliers, remember, you can put them on a very, like, I'm not, give me a supply. I ain't paying you today. I'm paying you 30 days from now. So again, everything's on the table to look at, right? Because what you're trying to do is close the cash gap. So if you can close the cash gap to the people you owe as well, then try to do that. You can put that in your contracts as well. I'll pay you net 30. I pay you net 60. You have the ability to do that as well, right? A lot of times, small business don't think about that, but you do. You can act just like what they're doing to you when you trying to collect. You can do the same thing. But again, you gotta be careful, right? It may, hurt that relationship that you have with a key supplier. But you gotta maybe sit down and talk to them. Hey, listen, the city is taking a long time to pay me. So, we're both in the game together. We're partners in here. So, at least give me 30 days to pay you, or give me 45 days to pay you versus paying you right away. Gotta think of it on whole sides. Yes.
Like, again, I was a small contractor, and I got it done with, let's say, the DDT for $1 million. And I go to another small contractor and I give a job to him and the subcontractor for $400,000. And now, I'm strapped for caps to pay him. He's strapped to caps to pay him. Right? But like, we feeling.
Yeah. I mean,
how do you mitigate that? What do we recommend?
Well, you gotta go to your client and say, hey, I need the money. Like, we gotta work it out. What is the process for me to get paid earlier? Because it's implicating everybody else. Otherwise, you should be paying me more. That's, again, what I tell big clients that they're saying, 90 days. I'm like, I didn't factor that in my cost. So now I got to redo my cost. What I'd rather do, instead of increasing the cost, because you may have to go get other approvals, move it down to 30 days, because that's reasonable. That's the standard. And sometimes they say, yeah, and sometimes, there'll be bold like, oh, no, there's another firm that will do it, and they'll do 90 days, so see you later. And we have to make that decision, do we want to say goodbye as well?
That's right. I think most of us are government. You have to zoom in on that. Negotiate or
The lump sum bid.
you just basically, if it's the DDC or the NDA, you go to the flow.
But you had it go.
Struggle is to get a contract much less than the OGA.
Right. But you got to keep it in mind all the time. Can you try it? Let's see what they say. I mean, I hear you. But part of it also is to learn how do I get, like you said earlier, all that paperwork. Okay, if I get that paperwork, be partners with them. And listen, you guys know I got to pay employees. I got to pay other subcontractors. How do we do it where we can make sure that we get paid timely? What happens?
It's with agency is a skill that you got to learn, skill of survival.
Right. It is.
Getting that agency, you got to learn how to survive. If they got the skill survive, it's not changing. You got to find a way how to survive.
I agree. Of course.
There's somebody who had a young friends working in both of those.
Okay.
Public or private, so big government corporations and big corporations. On the public side, I always told the contractors that were here, if your contract doesn't mirror ours, then you're already set up for failure. Right. And if anybody below you can't mirror that contract, then you don't need to be working with them on this project. Because as the government, I honestly, we have our general counsel, we have exactly how we're going to pay the schedule. It's been through policy, so there's really no you calling me is going to change that. So so you have to mirror that, and it's your due diligence to say, this is their contract. My contract to the one below me needs to look like this. And I have to have contingency. If that does not happen, then that's for you. That's not on the go.
Right. And I think what his point was that you got to have all that paperwork in to make sure that you can get paid when you hopefully will get paid. But they don't pay me timely and you still hunted it up. That's problematic. But you're absolutely right. That was kind of my point is this on that other side. That other side was that account payable. Exactly what you said. You support is that you're gonna have to tell your subcontractors, listen, you gonna have to wait. I can't just be paying you on your own. There's something that we're partners together in this.
And you know yourself to report, and you're getting trouble.
Well, and it's funny you say that because Zach, since sometimes I had some of the big county firms, and there was times, right, where the city particularly were like, you know, they got it on the system. You go online, they're like, did they pay you timely? I was like, nope. and they're like, oh, what are you doing about? I said, God, pay me timely. So I'm telling you.
Slow down.
Right now, you gotta be careful, right? Because they've been like, well, we ain't got to visit with Fred Davis again. But like we were, in a lot of points, Mitchell Tubbs were the only game in town in a lot of ways that they wanted to deal with. So they knew they had to start paying. But we paid the other ones beforehand. I said, oh, okay. I'll let them know. They paid the other two payments, but they only did it because I went in. I was just like, no, they ain't paid timely. So be careful with that too. When you have a chance to kind of blow them up a little bit, it may want to blow them up because they got paid.
Another thing, so is like for especially agencies, is to build a relationship with public management.
Right.
But when you got official and payment, people, you know, they the call and they're like, "Don't, I want to get involved."
You're gonna laugh at this. I did. So what I also did, not only did we did work for them as a contractor, they did work for me. And I didn't pay the other part of that big firm because I was like, I ain't get paid from these guys, right? So I said, net it off. And they're like, oh, no. So these guys got upset. How could you tell them that? I said, could you try to pay me? So I'm not paying. Why am I gonna pay your company money and then you owe me? That makes no sense. I'm netting it off. But you gotta be constant thinking that. Yes.
I don't want to ask about what you said about the loan. You said people need it, we get it.
Even if you don't.
Yeah, like concerning them, mostly what I always ask for men of credit. And they get it. So if we don't people use the line of credit, what did it say that?
Well, the whole thing is you will use it, even if you don't need it. You don't have to use the whole line of credit. So you get a line of credit of $100,000. You can pull down $20,000 and then pay it back. And so when they see that you're paying it back, like the bankers really see, they're like, all right, well, that's good for
You don't need a loan, but
right. You don't need a loan. You just do a line of credit. You don't need a loan. Nothing. But you eventually want to pull down from that line of credit so that it shows that you're worthy of getting credit, bigger credit down the road.
that means you don't even need to get it.
Even if you don't need it, right? Right. Even if you don't need it. Because what happens, you're actually showing that you're good for your payments and debt, in terms of debt. You right? I mean,
Yeah, you're saying the same thing.
Right.
Have a line of credit, you're fine. You don't leave the loan.
well, they don't. Oh, wow. I'm sorry. Right.
It's kind of
It's the same thing. If you have the line of credit that you're using, you don't really need to get the loan.
Oh, no, you don't know. I'm sorry. Yeah. You don't need to get the loan because you got the line of credit. Right.
It's the whole bag.
It's the loan.
You got the loan. You don't use it to pay.
the loan, you just gotta pay it. The line of credit, if you don't use it, you don't pay it.
If you have a line of credit, if you don't use it, you don't pay
And
it.
you don't pay this. You don't want to pay. So the loan you pay back into but you don't have to.
The line of credit becomes a loan, what's for it?
Yeah. Right.